On January 1, 2026, less than 12 months from now, the largest tax increase in American history takes effect automatically. Not through new legislation, not through a vote in Congress. Through a sunset provision that was written into law back in 2017 that most people have completely forgotten about. And if you have a net worth above $7 million, or if you're planning to inherit wealth from parents or relatives who do, this automatic tax increase is going to cost your family millions of dollars. I'm talking about the estate tax exemption cliff, the moment when the amount you can pass to heirs tax-free gets cut in half overnight, from $13.6 million per person down to roughly $7 million. That's a $6.6 million reduction in the exemption, which translates to about $2.6 million in additional estate taxes for anyone whose wealth falls in that gap. And the clock is ticking. Before we go further, I'd appreciate it if you could support this content by liking the video and subscribing to the channel with notifications enabled. It helps us continue bringing you this kind of analysis. I need to be very direct with you about something. I've spent nearly 50 years in finance. I've advised governments, institutions, family offices, ultra-high net worth individuals. I've seen tax law changes, regime shifts, regulatory overhauls. And I'm telling you that what's about to happen on January 1, 2026 is one of the most significant wealth transfer events in modern American history. Not because the law is changing, it's not. Because the law is reverting to what it was before 2017. And that reversion is going to catch millions of families completely unprepared. Let me explain what's happening and why it matters. In 2017, the Tax Cuts and Jobs Act was passed. Among many provisions, it roughly doubled the estate tax exemption, the amount of wealth you can pass to heirs without triggering federal estate tax. The exemption went from about $5.5 million per person to about $11 million per person, indexed for inflation. As of 2024, that exemption is approximately $13.6 million per individual, $27.2 million for a married couple. That's an enormous exemption. It means that if you have $13 million in total assets, your house, your retirement accounts, your investment portfolio, your business interests, your life insurance, everything, you can pass all of it to your heirs with zero federal estate tax. And if you're married, you and your spouse together can pass $27.2 million tax-free. But here's what most people don't realize. That doubled exemption was temporary. It was written into the law with a sunset provision that expires on December 31, 2025. On January 1, 2026, the exemption automatically reverts to roughly $7 million per person, adjusted for inflation. And unless Congress acts before then, which looks increasingly unlikely given political dynamics, that reversion is going to happen exactly as scheduled. What does this mean practically? If you die in 2025 with $13 million in assets, your heirs inherit everything tax-free. If you die in 2026 with the same $13 million in assets, your heirs get hit with federal estate tax on the $6 million that exceeds the new $7 million exemption. At a 40% estate tax rate, that's $2.4 million going to the IRS instead of to your children or grandchildren. Now, if you're sitting there thinking, Larry, I don't have $13 million, this doesn't affect me, let me explain why you're wrong. First, estate calculations include everything. Your home, your retirement accounts, your brokerage accounts, any business interests, life insurance death benefits, real estate holdings, collectibles, everything. Many people who don't think of themselves as wealthy discover they're above the threshold when you add it all up. Second, this affects inheritance planning even if your own net worth is below the threshold. If your parents have $10 million in assets and they're planning to leave it to you and your siblings, the estate tax bill just jumped from zero to over $1 million. That comes out of the inheritance. That's wealth that doesn't make it to the next generation. Third, and this is critical, estate values can grow between now and when you actually die. Maybe you have $8 million today. You're thinking you're under the new $7 million threshold, so no problem. But if you live another 20 years and your assets appreciate at 5% annually, you'll have $21 million when you die. Now you're $14 million over the exemption, and your heirs face a $5.6 million estate tax bill. Your wealth crossed the threshold not because you spent recklessly but because you invested prudently and your assets grew. Fourth, this interacts catastrophically with illiquid assets, particularly family businesses and real estate. Imagine you own a family business worth $15 million. Under current law, you could pass that business to your children tax-free. Under the reverted exemption, there's an $8 million excess over the exemption, triggering roughly $3.2 million in estate taxes. But the business doesn't generate $3.2 million in liquid cash sitting around. To pay the estate tax, your heirs might have to sell the business, or borrow against it, or liquidate other family assets. The estate tax forces a sale that wouldn't otherwise happen, destroying the continuity and value of a business that took generations to build. This is why I'm spending time on this. Because the implications are enormous, the timeline is compressed, and most families affected by this have no idea it's coming. They haven't planned for it. They haven't restructured their estates. They haven't taken advantage of the current high exemption while it still exists. And when January 1, 2026 arrives, it will be too late to do anything about it. Let me give you some numbers to show you the scale of what's happening. According to IRS data, there are approximately 150,000 to 200,000 estate tax returns filed annually. Under the current $13.6 million exemption, only about 1,800 of those estates actually owe federal estate tax, roughly 1%. That's because most estates are below the exemption threshold. The exemption is doing its job of protecting all but the wealthiest estates from taxation. But when the exemption drops to $7 million, the number of estates subject to tax is projected to increase to somewhere between 10,000 and 15,000 annually, a roughly 5 to 8-fold increase. That's 8,000 to 13,000 additional families per year facing estate tax bills they weren't expecting. And the revenue impact is substantial. The Joint Committee on Taxation estimates that the estate tax exemption reversion will raise approximately $75 billion to $100 billion over 10 years. That's $75 billion to $100 billion coming out of family wealth transfers and going to the federal government. For context, that's roughly equivalent to the entire annual budget of the Department of Education or the Department of Veterans Affairs. Now, I want to address the political question because I know some of you are thinking, won't Congress just extend the high exemption? Won't they fix this before it sunsets? And the honest answer is, maybe, but don't count on it. Here's why. First, extending the exemption requires affirmative legislation. It's not automatic. Congress would need to pass a bill, and the president would need to sign it. In the current political environment, with divided government or narrow margins, passing any significant tax legislation is extremely difficult. We've seen this play out repeatedly over the past decade. Tax provisions expire. Everyone agrees they should be extended, and yet they still expire because the legislative process breaks down. Second, the politics of estate tax are complicated. Polling consistently shows that a majority of Americans support some form of estate taxation on the wealthy. The narrative that only the ultra-rich pay estate tax has political appeal. Any effort to extend the high exemption will face pushback from progressive Democrats who argue it's a giveaway to the wealthy. And moderate Democrats who might otherwise support extension will face pressure from their base not to. Third, the revenue considerations are real. The federal budget is under enormous strain. Deficits are massive. There's pressure to find revenue wherever possible. Letting the exemption sunset generates $75 billion to $100 billion without anyone having to vote for a tax increase. It just happens automatically. That's politically attractive compared to having to affirmatively raise taxes elsewhere. Fourth, the 2024 election creates uncertainty. Depending on who controls Congress and the White House in 2025, the political will to extend the exemption might or might not exist. If Democrats control both chambers and the presidency, extension becomes very unlikely. If Republicans control, extension becomes more likely but still not certain given narrow margins and deficit hawks within the Republican caucus. The point is, you cannot plan your estate based on an assumption that Congress will fix this. You need to plan based on the law as written, which says the exemption drops on January 1, 2026. And if Congress does extend it, great, you can unwind some of the planning you did. But if they don't, and you haven't planned, you're going to lose millions of dollars in wealth transfer to taxation that could have been avoided. Let me talk about what planning actually means in this context because I think many people have misconceptions. Estate planning isn't just writing a will. A will doesn't reduce estate taxes. A will just directs how assets get distributed after you die. The assets are still in your taxable estate. Real estate tax planning involves strategies to remove assets from your taxable estate while you're still alive. And there are legitimate, legal, well-established techniques to do this. These aren't loopholes. These aren't shady offshore schemes. These are provisions written into the tax code explicitly to allow intergenerational wealth transfer in tax-efficient ways. The simplest technique is gifting. You can gift up to the current exemption amount, $13.6 million per person, $27.2 million per married couple, to your heirs right now, today, and those gifts use up your lifetime exemption but remove the assets from your estate. So if you have $20 million and you gift $13.6 million to your children this year, when you die your estate is only $6.4 million, which is below the post-2026 exemption of $7 million. Your heirs inherit everything tax-free even after the sunset. But here's the critical timing issue. To do this gifting, you need to complete it before December 31, 2025. You can't wait until 2026 and try to retroactively use the higher exemption. The exemption that applies is the exemption in effect at the time of the gift. So families that want to take advantage of the current high exemption have less than 12 months to execute potentially complex gift transactions. And gifting $13 million isn't simple. It requires valuations if you're gifting business interests or real estate. It requires legal documents, gift deeds, assignment agreements. It requires filing gift tax returns. It requires coordination with accountants and attorneys. And if you're gifting illiquid assets like businesses or real estate, it requires navigating minority interest discounts, control premiums, all sorts of technical issues that affect valuation. The point is, this isn't something you can decide to do in November 2025 and execute by year-end. The families that are going to successfully use the current high exemption are the ones that start planning now, in early 2025, giving themselves 8 to 10 months to structure everything properly. Now let me address another common misconception. Larry, I'll just leave everything to my spouse. There's no estate tax between spouses. And you're right, there's an unlimited marital deduction. You can leave your entire estate to your spouse with no estate tax. But that just defers the problem. When your spouse dies, the combined estate hits the next generation, and now the exemption applies. So if you and your spouse together have $25 million, and you die first in 2025 leaving everything to your spouse, no estate tax. But when your spouse dies in 2030 with that $25 million estate, and the exemption is now $7 million, there's $18 million of excess, triggering about $7.2 million in estate tax. The marital deduction didn't eliminate the tax, it just postponed it. There are sophisticated planning techniques to address this. Spousal lifetime access trusts, credit shelter trusts, qualified terminable interest property trusts. But these require proactive planning before the first spouse dies. You can't fix this retroactively. Let me also address the state estate tax issue because this compounds the federal problem. 12 states plus the District of Columbia have their own estate taxes separate from the federal estate tax. And many of these states have much lower exemptions than the federal exemption. Massachusetts and Oregon have exemptions of only $1 million. New York and Maryland have exemptions around $7 million. Illinois has a $4 million exemption. So even if you're well below the federal exemption, if you live in one of these states, you might face state estate tax. And when the federal exemption drops to $7 million, families that were planning based on the $13.6 million federal exemption are going to be shocked to discover they also owe state estate tax. For example, imagine you live in New York with a $10 million estate. Under current federal law, you're well below the $13.6 million exemption, no federal estate tax. But New York's exemption is only about $7 million. So you owe New York estate tax on the $3 million excess, roughly $450,000. You weren't planning for that. You thought you were safe. But because you didn't understand how state and federal estate taxes interact, your heirs lose $500,000. And here's where it gets really brutal. In some states, if your estate is even $1 over the exemption, you lose the exemption entirely and pay tax on the full amount, not just the excess. New York works this way. If you have a $7 million estate, no estate tax. If you have a $7.1 million estate, you pay estate tax on the full $7.1 million, not just the $100,000 excess. It's called a cliff, and it creates absurd incentives to spend down or gift away assets to stay just below the threshold. So when I talk about the estate tax exemption sunset, I'm not just talking about federal estate tax. I'm talking about a complex interaction between federal exemptions, state exemptions, marital deductions, lifetime gifting strategies, valuation issues, liquidity concerns, and a compressed timeline that makes all of this far more urgent than most families realize. This is not a problem you can ignore and hope it goes away. This is not a problem where you can wait until 2026 and figure it out then. The opportunity to plan, the opportunity to use the current high exemption, exists right now and ends on December 31, 2025. After that, the opportunity is gone. Millions of dollars in potential estate tax savings, gone. And what makes this particularly frustrating is that the families who will get crushed by this are often not the ultra-wealthy. The ultra-wealthy have sophisticated estate planning attorneys and accountants. They've been planning for this for years. They're already executing gifting strategies. The families that will get hurt are the upper middle class and merely affluent families. People with $8 million to $20 million in net worth who think of themselves as comfortable but not rich, who haven't focused on estate planning because they assumed they were below any meaningful threshold. These are business owners, successful professionals, people who bought real estate in appreciating markets, people who saved diligently and invested well. And through a combination of home equity, retirement accounts, brokerage accounts, and maybe a small business or rental property, they've accumulated $10 million or $15 million. They're not living extravagant lifestyles. They're living in the same house they bought 30 years ago that's now worth $3 million. They're driving normal cars. They're planning normal retirements. And they have no idea that on January 1, 2026, their estate tax situation changes fundamentally. That the tax bill their heirs will face jumps from zero to potentially millions of dollars. That wealth they spent a lifetime building is going to be partially confiscated unless they take action in the next 12 months. That's what I'm trying to prevent. That's why I'm spending time on this. Because the families who need this information most are the ones least likely to be getting it. And the window to act is closing rapidly. Let me walk you through the specific planning strategies that are available right now, before the exemption sunsets, and explain how to think about which ones make sense for different family situations. Because this isn't one size fits all. The right approach depends on your net worth, your liquidity, your family dynamics, your age, and your goals for wealth transfer. Start with the most straightforward strategy, direct lifetime gifting. Under current law, you can gift up to $13.6 million per person to anyone, children, grandchildren, other heirs, and that gift uses up your lifetime exemption but removes the assets from your taxable estate. For a married couple, that's $27.2 million you can transfer right now, this year, and it's out of your estate forever. The mechanics are relatively simple. You transfer assets, cash, securities, real estate, business interests, to your intended heirs. You file a gift tax return reporting the transfer. The IRS tracks the gift against your lifetime exemption. No tax is paid as long as the gift is within your available exemption. And crucially, any future appreciation on those gifted assets happens outside your estate. If you gift $10 million in stock today and it grows to $20 million by the time you die, that $10 million of appreciation isn't in your estate. Your heirs get it tax-free. This is enormously powerful from a wealth transfer perspective, but it requires overcoming a significant psychological barrier that I see with families all the time: the reluctance to give up control and access to assets while you're still alive. People worry, what if I need that money? What if I live another 30 years? What if my healthcare costs are higher than expected? What if the market crashes and my remaining assets aren't enough? These are legitimate concerns. And this is why pure direct gifting often makes most sense when you have substantial assets beyond the exemption amount. If you have $30 million and you gift $13.6 million, you still have $16.4 million for your own needs. You're not impoverishing yourself. You're strategically moving wealth that exceeds your lifetime needs out of your taxable estate. But if you have $15 million total and you're considering gifting $13.6 million, that's different. Now you're left with only $1.4 million for potentially 20 or 30 years of retirement. That might not be enough depending on your lifestyle and longevity. So you need more sophisticated structures that allow you to remove assets from your estate while maintaining some level of access or benefit. This is where trusts become critical. And I want to explain the key trust structures that are being used extensively right now by families planning for the exemption sunset. First, the Spousal Lifetime Access Trust, or SLAT. Here's how it works. You create an irrevocable trust for the benefit of your spouse. You gift assets into the trust, using your lifetime exemption. The trust is structured so that your spouse can receive distributions from the trust during their lifetime, for health, education, maintenance, support, typically. But because the trust is irrevocable and independent, the assets aren't in your estate when you die. And because your spouse has access to the trust assets, indirectly you have access through your spouse if needed. The SLAT is powerful because it threads a difficult needle. getting assets out of your estate while maintaining indirect access through your spouse's ability to take distributions. If you gift $10 million into a SLAT in 2025, that $10 million plus all future growth is removed from your taxable estate. But if circumstances change and you need access to capital, your spouse can request distributions from the trust that can be used for household expenses, healthcare, whatever. There are risks and limitations. The trust is irrevocable. You can't change your mind and take the assets back. If you divorce, the trust remains for your ex-spouse's benefit, which creates obvious problems. If your spouse dies before you, the access disappears. And you have to be careful about reciprocal trust doctrines. If both spouses create identical SLATs for each other, the IRS might collapse them and treat them as if the assets never left the estates. But used carefully, SLATs are one of the most effective tools for using the current high exemption while maintaining family access to assets. I'm seeing a massive increase in SLAT creation right now as families recognize the urgency of the exemption sunset. Second structure. Grantor Retained Annuity Trusts, or GRATs. The GRAT is a different mechanism for wealth transfer that's particularly effective when you have assets you expect to appreciate significantly. Here's the structure. You transfer assets into an irrevocable trust for a term of years. Say, 2 years or 5 years or 10 years. During that term, the trust pays you an annuity, a fixed annual payment. At the end of the term, whatever remains in the trust passes to your beneficiaries, typically your children, gift tax-free. The key is the IRS formula for valuing the gift. When you create the GRAT, the IRS calculates the present value of the annuity stream you'll receive and subtracts that from the value of the assets you put in. The remainder, what's expected to be left after the annuity payments, is the taxable gift. But here's the magic. If the assets in the GRAT appreciate faster than the IRS assumed interest rate, the excess appreciation passes to beneficiaries with no gift tax. Let me give you a concrete example. Say you put $10 million of stock into a 2-year GRAT. The IRS assumes a 5.6% annual return based on current rates. So they expect the $10 million to grow to about $11.15 million over 2 years. You structure the annuity to pay back approximately $11.15 million over those 2 years, which means the taxable gift is essentially zero. There's no expected remainder after the annuity payments. But suppose the stock actually appreciates 20% per year. After 2 years, the portfolio is worth $14.4 million. You take your annuity payments of $11.15 million. That leaves $3.25 million in the trust that passes to your children with no gift tax. You've successfully transferred $3.25 million using none of your lifetime exemption. GRATs work beautifully with volatile, high-growth assets. Stock in a company about to go public. Concentrated positions in high-growth tech stocks. Real estate in rapidly appreciating markets. Anything where you have good reason to believe actual returns will exceed the IRS assumed rate. The risk is that if the assets don't appreciate, if they stay flat or decline, nothing passes to beneficiaries. You get your annuity back, but you haven't accomplished any wealth transfer. Also, you have to survive the GRAT term. If you die during the term, the assets come back into your estate. So GRATs work best with shorter terms, 2 to 4 years, where mortality risk is minimal. Third structure. Intentionally defective grantor trusts, or IDGTs. This is a more advanced technique but incredibly powerful. The trust is defective for income tax purposes, meaning you, the grantor, pay income taxes on the trust's earnings even though the assets are outside your estate for estate tax purposes. This sounds like a disadvantage, but it's actually beneficial because you're paying taxes on behalf of the trust, which allows more wealth to compound for your beneficiaries without being reduced by taxes. Here's a typical structure. You create the IDGT and seed it with a small gift, maybe $100,000, using a tiny portion of your exemption. Then you sell assets to the trust in exchange for a promissory note. The trust owes you, say, $10 million based on the value of the assets sold, payable over 10 or 15 years with interest at the IRS minimum rate. Because it's structured as a sale, not a gift, there's no gift tax on the $10 million transfer. The $10 million of assets is now in the trust, outside your estate. Future appreciation on those assets happens in the trust, not in your estate. The trust pays you annual interest, which you can use for living expenses. And you pay the income taxes on the trust's earnings, which further reduces your taxable estate while allowing more to accumulate in the trust. At the end of the note term, the trust has paid you back the $10 million plus interest. But if the assets appreciated significantly, say they're now worth $20 million, that $10 million of appreciation has transferred to your beneficiaries with no gift or estate tax. The IDGT is technically complex. You need proper valuation of the assets being sold. You need to structure the note correctly to avoid having the sale recharacterized as a gift. You need to ensure the trust has enough liquidity to make note payments. But for sophisticated families with significant wealth, it's one of the most tax-efficient wealth transfer mechanisms available. Fourth strategy: family limited partnerships or LLCs combined with gifting. This is particularly valuable when you have real estate, business interests, or investment portfolios that you want to maintain some control over while still removing value from your estate. Here's the structure. You create a family limited partnership or LLC and transfer assets into it. Say $10 million of investment real estate or a brokerage account. You retain the general partner or manager interest, which gives you control over the assets. Then you gift limited partnership interests to your children or to trusts for their benefit. The key advantage is valuation discounts. A limited partnership interest that represents 10% of the underlying assets is worth less than 10% in fair market value because it lacks control and lacks marketability. A limited partner can't force distributions, can't force sale of assets, can't easily sell their interest to a third party. These restrictions reduce the fair market value of the gifted interests, often by 25% to 40%. So if the underlying assets are worth $10 million, and you gift 90% limited partnership interests to your children, you're not making a $9 million gift. You might be making a $6 million gift after discounts. You've successfully transferred $9 million of underlying value using only $6 million of your gift tax exemption. And you still control the assets as general partner. There are strict rules about how these entities must be structured and operated to get valuation discounts respected by the IRS. You can't create a shell entity just for tax avoidance. There has to be legitimate business purpose. The partnership has to operate like a real partnership with proper governance. But when done correctly, this is a powerful wealth transfer tool that's particularly useful for families with illiquid assets. Fifth strategy: charitable lead trusts for families with philanthropic intent. If you're planning to make substantial charitable gifts anyway, a CLT can accomplish both charitable giving and wealth transfer to heirs tax efficiently. The structure: you transfer assets into an irrevocable trust. The trust makes annuity payments to charity for a term of years, say 15 or 20 years. At the end of the term, remaining assets pass to your beneficiaries. The taxable gift is the present value of what's expected to pass to beneficiaries at the end of the term, which can be quite low if the charitable term is long and the assumed IRS interest rate is reasonable. You're essentially using the charity to zero out much of the taxable gift. The charity gets substantial funds over the trust term. Your beneficiaries get whatever's left, which if the assets appreciate well, can be significant. And you've transferred wealth using minimal lifetime exemption. Now, let me address the practical challenge that makes all of this urgent: execution timeline. These strategies aren't theoretical exercises you can contemplate leisurely. They require real legal and financial work, and that work has to be completed before December 31, 2025. Consider what's involved in creating and funding a SLAT. You need estate planning attorneys to draft the trust document. You need to decide what assets to transfer: cash, securities, real estate, business interests. If you're transferring business interests or real estate, you need professional valuations. You need to actually execute the transfer, retitle accounts, record deeds, execute assignments. You need to file gift tax returns reporting the transfers. Each of these steps takes time. Getting a professional valuation for a business might take 30 to 60 days. Drafting complex trust documents might take several weeks, especially as attorneys get overwhelmed with year-end demand from other families also trying to beat the deadline. Retitling real estate requires recording documents with local governments, which can take weeks depending on the jurisdiction. And this assumes everything goes smoothly. If there are complications, disputes about valuations, questions about trust provisions, delays in getting documents signed, the timeline extends. This is why I'm emphasizing the urgency now, in early 2025. Families that wait until October or November to start this process are going to face a crisis. Estate planning attorneys are going to be completely overwhelmed in Q4 2025 with families desperately trying to beat the deadline. You'll struggle to get appointments. You'll pay premium fees for rushed work. You might simply run out of time. The families that are going to successfully execute these strategies are the ones that start now. That engage counsel in January or February 2025. That begin the valuation process in spring. That have everything drafted and reviewed by summer. That execute transfers in September or October. That file gift tax returns in November. That leave themselves buffer time for unexpected complications. Let me also address the question of whether to wait and see if Congress extends the exemption. I've heard this from multiple families. Larry, why should we rush to do complicated, expensive estate planning if Congress might just extend the high exemption and we won't need it? Here's my answer. Even if you think there's a reasonable chance of extension, the cost of being wrong is too high to ignore. If you plan for the sunset and Congress extends the exemption, you've incurred some legal fees and gone through some complexity. But you still own the assets, just in different structures. You can potentially unwind some of the planning. Your downside is limited, but if you don't plan, assuming extension, and Congress doesn't extend, your downside is millions of dollars in unnecessary estate taxes. You've permanently lost the opportunity to use the $13.6 million exemption. Your heirs paid $2.6 million more in estate taxes on every $6.6 million of assets above the $7 million exemption. That's not recoverable. From a risk management perspective, the prudent choice is clear. Plan for the sunset. Use the current exemption. If Congress extends, great, you have some flexibility to adjust. If Congress doesn't extend, you've protected your family from a massive tax hit. Think about it this way. If I told you there was a 50% chance your house was going to burn down next year, would you insure it? Of course you would, even though there's a 50% chance you wasted your insurance premium. The asymmetry of outcomes, losing your house versus paying an unnecessary premium, makes the decision obvious. Same logic applies here. Even if you think there's only a 40% or 50% chance the exemption actually sunsets, the magnitude of the potential loss makes planning imperative. You're buying insurance against a legislative outcome that would be catastrophic for your family's wealth transfer. Let me address one more critical issue: the interaction between estate planning and income tax basis step-up. This is a technical point, but it matters enormously for families with highly appreciated assets. Under current law, when you die, your heirs receive a step-up in basis for inherited assets. If you bought stock for $1 million and it's worth $10 million when you die, your heirs inherited with a $10 million basis. If they sell immediately, they pay no capital gains tax on that $9 million of appreciation. The appreciation is forgiven for income tax purposes. But assets you gift during life don't get a basis step-up. If you gift that same stock to your children while you're alive, they take your $1 million basis. When they eventually sell for $10 million, they owe capital gains tax on the $9 million gain. So there's a trade-off. Gifting removes assets from your estate and saves estate tax, but costs income tax basis step-up. For highly appreciated assets, you need to calculate whether the estate tax savings from gifting outweighs the capital gains tax cost from losing the step-up. The math depends on estate tax rates versus capital gains rates, the amount of appreciation, your heirs' income levels and tax brackets, and their intentions for holding or selling the assets. Generally, if estate tax would be 40% and capital gains tax would be 23.8%, estate tax is more punishing and gifting makes sense. But every situation requires specific analysis. This is another reason why DIY estate planning is dangerous. The interaction between estate tax, gift tax, income tax, generation skipping transfer tax, state estate tax, and basis step-up rules is complex enough that you need professional guidance to avoid costly mistakes. The expense of hiring competent counsel is trivial compared to the potential tax savings. One final point about family dynamics. Estate planning isn't just technical and financial. It's emotional and relational. Gifting significant assets to children raises questions about fairness, control, responsibility, and family harmony. What if you have 3 children but one is much more financially responsible than the others? Do you gift equally, knowing one might squander it? What if you're concerned about a child's spouse potentially claiming assets in a divorce? What if you want to incentivize certain behaviors, education, work ethic, charitable giving, before children receive substantial wealth? These questions don't have purely technical answers. They require family conversations, potentially family governance structures, and trust provisions that reflect your values and goals beyond just tax minimization. Good estate planning attorneys will help you think through these issues, not just draft documents. But these conversations take time. You can't have meaningful family discussions about wealth transfer, values, and legacy in a rushed 2-week process in December 2025. This is another reason to start planning now. Give yourself time to think deeply about not just how to transfer wealth tax efficiently, but how to transfer it in ways that benefit your heirs and reflect your values. The exemption sunset is creating massive urgency. But that urgency shouldn't force you into hasty decisions you'll regret. Start now, move deliberately, think carefully, execute properly. That's how you'll successfully navigate this moment. Let me bring this to a practical conclusion by walking you through a decision framework for determining whether you need to act on the exemption sunset and, if so, how urgently and with what strategies. Because not everyone watching this needs to do complex estate planning in the next 12 months. But some of you absolutely do, and the cost of misidentifying which category you're in is potentially millions of dollars. Start with the threshold question. What's your current net worth, and what's your projected net worth at life expectancy? Net worth for estate tax purposes includes everything: your home, vacation properties, retirement accounts, brokerage accounts, business interests, life insurance, death benefits, valuable collections, everything. Many people significantly underestimate their estate value because they don't aggregate all these components or because they haven't updated valuations in years. If your current net worth is below $7 million and you're retired or near retirement with minimal growth expected, you're probably safe. The post-2026 exemption of roughly $7 million will cover your estate even after the sunset. You don't need urgent planning. But if your current net worth is above $7 million, or if you're younger with assets that will likely grow above $7 million by life expectancy, you need to pay attention. And if your net worth is above $13.6 million, the current exemption, you absolutely need to act because you're already beyond the threshold and the sunset will make your situation significantly worse. Let me give you some scenarios to illustrate the decision calculus. Scenario 1. You're 45 years old, married, with a combined net worth of $10 million. Your assets are primarily in retirement accounts and a home. You're still working, saving about $200,000 per year, and you expect your assets to grow at roughly 6% annually for the next 20 years. By age 65, your net worth will likely exceed $40 million. In this scenario, you desperately need to use the current high exemption. If you gift $13.6 million per spouse, $27.2 million total. In 2025, you remove that $27.2 million plus all future growth from your estate. That $27.2 million, growing at 6% for 20 years, becomes $87 million, all outside your taxable estate. The estate tax savings from this planning could easily exceed $30 million. But you're also relatively young and still accumulating. You might not feel comfortable gifting $27.2 million outright because you're still building your career and your wealth. This is the perfect situation for slats. One spouse creates a trust for the other, removing assets from the estate while maintaining indirect access through the beneficiary spouse. You get the estate planning benefit without completely severing access to the assets. Scenario 2. You're 70 years old, widowed, with a net worth of $15 million, mostly in liquid securities in your home. You have 3 adult children you want to leave everything to. You're living on $150,000 per year from investment income and Social Security, comfortable and not needing to access principal. In this scenario, direct lifetime gifting makes tremendous sense. You can gift $13.6 million to your children or to trusts for their benefit in 2025. You retain $1.4 million plus your home and future investment income, which is more than adequate for your remaining lifetime needs. The $13.6 million you gift, if it continues growing at 7% annually, might be worth $25 million by the time you pass in 15 or 20 years. All that growth happens outside your estate. The alternative, doing nothing, means your $15 million estate faces roughly $3.2 million in estate taxes under the post-2026 exemption. Your children inherit $11.8 million instead of $15 million. By gifting now, you save your family $3.2 million in estate taxes plus you remove future growth from your estate. Scenario 3. You're 60 years old, married, with $25 million net worth, but $15 million of that is tied up in a family business that generates your income. The business is illiquid. You can't easily sell it or distribute it. The other $10 million is your home, retirement accounts, and some liquid investments. This scenario is more complex. You need the business for income, so you can't gift it entirely. But you can gift minority interests in the business using valuation discounts. Maybe you create a family LLC, transfer the business into it, and gift 40% LLC interests to your children. With appropriate discounts, that 40% interest worth $6 million in underlying value might be valued at only $4 million for gift tax purposes, using $4 million of your exemption while transferring $6 million of value. You could also gift the liquid $10 million outside the business. Or use a GRAT with some of the liquid securities if you expect strong appreciation. The point is, even with illiquid assets, there are strategies to use the current exemption. You just need more sophisticated structuring. Scenario 4. You're 55 years old with $8 million net worth, but you live in New York, which has a $7 million state estate tax exemption. You're not worried about federal estate tax under either the current or future exemption. But you are exposed to New York estate tax. Here's the issue. New York's exemption doesn't sunset because it's not tied to the federal exemption. It's a fixed state-level exemption. So you face New York estate tax on the $1 million excess over the state exemption regardless of what happens with federal law. And remember, New York has a cliff. If you're over the exemption by even a small amount, you lose the exemption entirely and pay tax on the full estate. Your planning focus should be on getting below the New York $7 million threshold. Maybe you gift $1.5 million to children, getting you comfortably below $7 million. Or you move to a state with no estate tax, Florida, Texas, Nevada, which eliminates the state estate tax issue entirely. Geographic arbitrage is a legitimate estate planning strategy when state estate taxes are the primary concern. Now, let me address the situation many of you are in. You recognize you need planning, but you're overwhelmed by the complexity and the urgency. You don't know where to start. You don't know what questions to ask. You're worried about making expensive mistakes. Here's my recommended action plan, step by step, for someone who needs to use the current exemption before it sunsets. Step 1. Right now, this month, calculate your accurate net worth. Include everything. Get updated valuations for your home, your business if you own one, any real estate. Add up all financial accounts. Determine the death benefit on life insurance policies. Create a comprehensive balance sheet. Once you have this number, you know whether you're above the $7 million threshold where the sunset matters. If you're above it, you need to keep going. If you're comfortably below it and not expecting significant growth, you can relax somewhat, though you should still consider planning if you're in a state with its own estate tax. Step 2. Engage an estate planning attorney who specializes in high net worth estate planning and is familiar with the exemption sunset. Not a general practice attorney who does wills on the side. Not the attorney who handled your house closing. A specialist who does sophisticated estate planning regularly. Ask about their experience with SLATs, GRATs, IDGTs, family partnerships. Ask how many sunset-related plans they've implemented in the past year. Ask about their timeline. Can they complete planning by mid-year, or are they already backed up? Get multiple consultations. Estate planning attorneys aren't commodities. Their sophistication, creativity, and attention to detail vary enormously. The difference between competent and excellent counsel could mean millions in tax savings or avoided problems. Step 3. Work with your attorney to develop a plan appropriate to your situation. This requires full financial disclosure to the attorney, discussion of family dynamics and goals, analysis of different strategies, and decision-making about which approach fits your circumstances. This step takes time. It's not a single meeting. You'll have initial consultations, then the attorney will analyze your situation, then you'll have follow-up meetings to review options, then you'll make decisions, then the attorney will draft documents, then you'll review drafts, request revisions, finalize. A realistic timeline from initial consultation to fully executed plan is 3 to 6 months for moderately complex situations, potentially longer if you have complicated business structures or illiquid assets requiring valuations. This is why starting now, in early 2025, is critical. If you start in January or February, you can complete planning by summer, giving yourself comfortable buffer before year-end. If you wait until July or August, you're cutting it close. If you wait until October or November, you're in crisis mode and might not finish in time. Step 4. If your plan involves gifting business interests or real estate, get professional valuations. This is non-negotiable. The IRS will challenge undervaluations, and you need defensible appraisals from qualified professionals. This process typically takes 30 to 60 days and should be initiated as soon as you've decided what assets you're gifting. Step 5. Execute the plan. Sign trust documents. Fund trusts with assets, retitle accounts, record deeds, execute assignments. Make sure everything is properly documented and transferred before December 31, 2025. This execution phase is where things can go wrong if you're rushed. Retitling accounts requires coordination with financial institutions, which have their own bureaucratic timelines. Recording real estate deeds requires filing with local government offices, which can be slow. If you're transferring business interests, you might need consent from partners or lenders. Build in buffer time for delays and complications. Step 6. File gift tax returns by April 15, 2026, or October 15, 2026 if you extend. The gift tax return reports your 2025 gifts and calculates how much of your lifetime exemption you've used. This filing is required even though you owe no tax if you're within the exemption. And it starts the statute of limitations running on IRS challenges to valuations. Make sure your return is prepared by someone experienced with large gift tax returns. Errors or omissions can create problems years later when your estate is being settled. Now, let me address the emotional and psychological dimension of this planning, because I think it's often underestimated. Making irrevocable gifts of millions of dollars to your children or to trusts is not purely a financial decision. It's an identity decision, a control decision, a family relationship decision. You're acknowledging your mortality. You're transferring wealth and potentially power to the next generation. You're making permanent decisions that can't be undone. If you have complicated feelings about your children, about wealth, about aging and death, all of that gets activated by estate planning. Some people I've worked with over the years find this process liberating. They're ready to pass the torch, ready to see their wealth benefit their heirs, ready to simplify their own lives. For them, estate planning is a positive experience. Others find it anxiety-inducing. They're not ready to let go of control. They worry about their children's readiness to manage wealth. They fear becoming dependent or losing independence. For them, estate planning feels like a loss even as they intellectually understand it's beneficial. Both reactions are normal and valid. The key is not to let emotional discomfort prevent you from doing planning that's financially necessary. If you're struggling with the emotional aspects, consider working with a family wealth consultant or therapist who specializes in wealth transition issues. Consider involving your children in the planning process so it feels collaborative rather than imposed. Consider structuring trusts with provisions that address your concerns, incentive provisions, spendthrift protections, independent trustees who provide oversight, staggered distributions over time rather than lump sums. The worst outcome is letting psychological discomfort lead to inaction, which leads to your family paying millions in unnecessary estate taxes. Work through the discomfort, address the concerns, but execute the planning. Let me also address what happens if you don't act before the deadline. If you wake up on January 1, 2026 and you haven't done planning, what are your options? First, the exemption you didn't use is gone forever. You can't retroactively make 2025 gifts in 2026 and claim the higher exemption. The window closed. Second, you're now planning with a $7 million exemption instead of $13.6 million. You can still do estate planning, slats, grats, all the strategies still work. You just have half the exemption to work with. You can gift $7 million instead of $13.6 million. The estate tax savings from planning are smaller but still meaningful. Third, if Congress extends the exemption retroactively or prospectively after the sunset, you might get relief. But don't count on it. Plan for the law as written. Fourth, you can focus on other tax minimization strategies that don't depend on the exemption. Charitable planning, which removes assets from your estate regardless of exemption levels. Spending and consuming assets during your lifetime rather than leaving them to be taxed at death. Moving to a state with no estate tax to at least avoid state-level estate taxation. But the bottom line is, missing the December 31, 2025 deadline is costly. It's a missed opportunity that can't be recovered. This is why I'm spending time on this now, in early 2025, while there's still time to act. Let me end with the big picture. The estate tax exemption sunset is a technical tax provision, but it has profound implications for intergenerational wealth transfer, for family financial security, for economic mobility, for business succession, for everything that families with accumulated wealth care about. Over the next 12 months, there's going to be the largest intergenerational wealth transfer driven by tax planning in modern American history. Families that understand the exemption sunset and act on it will transfer tens of billions of dollars to the next generation tax efficiently. Families that don't understand it or don't act will pay billions in unnecessary estate taxes that could have been avoided. The difference between these outcomes is not intelligence or sophistication or wealth. It's awareness and action. Knowing this is happening, understanding the implications, engaging professionals, making decisions, executing plans. You now have the awareness. I've explained what's happening, why it matters, what the stakes are, and what strategies exist. The question is whether you'll take action. Whether you'll start the planning process now, while there's still time. Whether you'll have the difficult conversations with family and advisors. Whether you'll execute before the deadline. I can't make those decisions for you. I can only tell you that the families I work with, the families that successfully navigate complex wealth transitions, are the ones that face reality, plan proactively, and execute decisively. They don't procrastinate. They don't hope problems will solve themselves. They don't wait for perfect certainty before acting. They assess the situation, determine the risks, identify solutions, and implement them. And that's exactly what you need to do with the exemption sunset. Assess your estate. Determine your exposure. Identify appropriate planning strategies. Implement them before December 31, 2025. The clock is ticking. The deadline is absolute. The stakes are millions of dollars in your family's wealth. Don't let inertia or complexity or emotional discomfort cost your family that wealth. Act now. Start the process. Protect what you've spent a lifetime building. Because on January 1, 2026, the rules change. And families that prepared will be fine. Families that didn't will face tax bills that could have been avoided. Make sure you're in the first category.